This episode is brought to you by Marqeta. Payment programs that scale and customer experiences that inspire. Don't sacrifice one for the other. Choose a payments provider who can deliver on both. Choose Marqeta. Learn more at marqeta.com/FTT. Hello, and welcome back to another edition of Fintech Recap, featuring the author and publisher of Fintech Business Weekly and my friend Jason Mikula. Jason and I just got done spending a couple of weeks together out on the road at various events, including the Fintech Takes Builders Summit. But it was great to get to talk to him about what has been happening lately in fintech news. Headlines include multiple interesting developments in the ongoing open banking saga, the reprivatization of Green Dot and what that means for the future of banking as a service, Apple's initiatives in digital identity and what it means for the future of digital identity overall, as well as some truly insane stories that we couldn't let go of. As always, I really enjoyed just getting to catch up with Jason and talk about how crazy everything is in fintech. This will be coming out after the Thanksgiving holiday. So I hope everyone had a good Thanksgiving and is getting excited for a good holiday season. This will be the last FinTech recap that we publish of 2025. And I want to say a special thank you to Jason. As always, he's been a wonderful collaborator and someone I learn a lot from and really count on to do my job better. So grateful to have had another chance to do a year of FinTech recaps with him. We will carry it into 2026. So without further ado, here is Fintech Recap with Jason Mikula. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. All right, Jason Mikula is here. It's strange because I've seen you so many times recently in person that this feels somehow impersonal to do this podcast over the internet, but it's great to see you again. How are you?
My voice is a little worse for the wear, but I guess our listeners can just enjoy the extra dulcet tones for this month's FinTech recap. But otherwise, I am good. I would say, I am glad to be home, but I'm also, we're recording this at 5 p.m. my time, and it's basically pitch black outside, somewhat cold and a little bit wet, which I don't like. And the smaller of our two dogs really does not enjoy. So it's adjusting to some seasonal depression.
I get it. Yeah, it's also very dark here in Montana, which you actually got to experience because you were here recently. Which
was
for
lovely,
making
by
the trip.
way. Lovely.
I am so glad to hear that. We, for listeners, hosted our first ever Fintech Takes Builders Summit a couple of weeks ago in Bozeman, and really, it was an excuse to get all my favorite people together in my hometown, which was pretty awesome. And Jason very generously made the trip all the way out. And we had really good weather for you then. I will tell you that since then, snow squalls have blown in. In fact, my home lost power yesterday. So I had just a random break in the middle of the day, thanks to no electricity due to snowstorms. So we're in winter now, but I'm glad you got to experience the last little burst of non-winter in Montana.
Yeah, it really wasn't bad at all. It was colder in DC, I think.
Yeah. It was. Yes. And it's been, for both of us, actually, Montana to DC for AFC Policy Summit, to Miami for FinTech NerdCon, and then finally, Jason, a chance to rest. I hope you're getting a good couple of months at least, right? Hopefully, fingers crossed.
Yeah, I don't have any. The earliest work-related travel that is in the consideration set, I'll put it that way, is FinTech Exchange in Salt Lake, which is sometime next February. I forget exactly when, but
it is. That's right. It's early February. That one's easy for me, so I will probably make it. Certainly understand if you do not, because I know it's a much longer hike for you, but it's a fun event.
Yes, well, and I've been told there's a full ski day, so maybe that'll convince me.
That is true. That is very, very true. All right, Mr. Mikula, a lot has happened while we've been out on the road, so we have plenty to discuss. Do you mind if I give us a quick open banking update?
Yeah, please do. There have been quite a few little bits and bobs there in that twisted tale.
There really have. There really have. So there's been some reporting both from Bloomberg Law and from CNBC recently, sort of giving us some updates on what's happening here. So we'll start with the news from CNBC. The headline was kind of funny. It was JP Morgan Chase wins fight with fintech firms over fees to access customer data. I think that might be a little bit of an unnuanced headline because they definitely did not get exactly what they maybe set out to get at the beginning, which were fees that were quite a bit higher. But, and you and I have already talked about this in regards to the news about Chase striking a deal with Plaid to collect fees for access to its open banking APIs. CNBC now reports that a number of other data aggregators, including Yodlee, Morningstar, and Akoya, all have also agreed to deals with Chase to pay for their data. Supposedly, that covers more than 95% of the data pulls on its systems. I don't know that 95% number is exactly in the right context because it still, from my count, is missing some fairly significant data aggregators, including Finicity / MasterCard, Stripe, Trustly, and MX, among others. So I don't think it's completely comprehensive. And, there's lots of different ways to calculate what 95% is actually in reference to. But all the same, Chase has clearly expanded its deals across multiple aggregators. I'm not terribly surprised by any of these. Morningstar is a data aggregator that focuses on the wealth management space. So it's actually not covered by the open banking rule. So they were always going to have to sort of play a slightly different game. Yodlee is a long-time data aggregator, one of the first, and also one that has the most institutional bank relationships as customers. And so also did not surprise me that they came to a deal. And of course, Akoya is owned by a consortium of large banks, including Chase. So shocked, I say, to hear that they have come to a deal with Chase as well. The other little bit of news from our friend Evan Weinberger at Bloomberg is that the CFPB is apparently going to try to get at least some version of its updated rule on 1033 done by the end of the year. Jason, just a sanity check for me, because I still have some holiday shopping to do. The end of the year is pretty close, isn't it?
The end of the year is pretty close. By the time this publishes, it'll be less than 1 month, which would be quite the record turnaround for doing an APA compliant rule.
It would. There's traditionally, and we'll just lay out the traditional process. Traditionally, the APA, the Administrative Procedures Act, requires that a rule like this go through an advance notice of proposed rulemaking, which the CFPB has done. It's worth noting that multiple people I talked to strongly suspect that the ANPR that the CFPB put out was written using ChatGPT. Take that for whatever you will, and was not particularly comprehensive, but they did publish it. They got feedback on it, and supposedly they are in the process of ingesting that feedback and using that to help guide their rulemaking process. The other thing that they're supposed to do as a part of the rulemaking process for any regulation that has a significant impact on small businesses is to do a small business review where they sit down with a panel of different small businesses that would be affected by the rule. In this case, think about a small data aggregator, or maybe a fintech startup, or maybe a community bank, and basically review what the impact of the rule potentially would be on their businesses, take that information into consideration in the rulemaking process. That SABRIFA process is, according to folks I've talked to who've been through it, quite the lengthy and painful process if you do it the right way. And then after doing that, and after taking that feedback in, then publishing a draft rule. and then allowing another notice and comment period for the industry to supply comments before finally taking in all of that feedback and finalizing the rule and publishing a final rule. That process, if you were to follow it, would take, I don't know, a year, 18 months, 24 months. Like, it could take a long time. Like, you would be actually, from folks I've talked to, the CFPB, if they were to follow the process, would almost be up against the gun of the Trump administration running out its term, right? So instead of doing that, they apparently are trying to get it done by the end of the year, which I don't even know how you would do that. In the story that Evan published at Bloomberg Law, they talked about maybe working with the Small Business Administration to try to do some type of accelerated SBREFA process to get input from small businesses, or maybe not doing that at all. They talked about maybe just publishing an interim final rule where they wouldn't actually take any additional feedback. But suffice it to say, any way that they could possibly do it and get it done by the end of the year would be skipping many, many steps. That is relevant because when the Bank Policy Institute sued the CFPB after the Biden administration, CFPB published their final rule, every claim in that lawsuit alleged violations of the APA. So well, I don't know that it will be BPI the second time around who will sue over APA violations. Someone will, and someone will have standing to bring that lawsuit. So that already is a problem. Layer on top of that, the other interesting little bit of news from Evan, which is that according to the sources he has spoken to, the CFPB is planning to explicitly allow fees under its new rule. So this was obviously one of the big points of contention. This is the issue that Chase sort of forced to the forefront with its maneuvers. Supposedly, the CFPB is going to write into the rule a provision allowing data providers to charge fees. However, they are going to put guardrails around that allowance, basically requiring that banks only charge fees that are based on cost recovery and basically covering the cost that it takes to stand up and operate the APIs. Now, I guess, Jason, I have many, many questions, but one I'll start with for you is how, if you were one of the few people still working at the CFPB, how would you go about crafting a set of guardrails to make sure that banks only charged fees that were based on their costs for standing up and supporting those APIs? Like operationally, how would you do that?
I mean, that is an incredibly complex question that I don't think the Five Guys ham sandwich and Chat GPT subscription, if they can still afford it, at the CFPB are really capable of solving in the next whatever months. And frankly,
3 weeks. Right. Yeah, totally.
I mean, at this point, my cynicism is just like pegged off the charts. And there's what I suspect is going to happen, which is, I mean, taking Evan's reporting at face value, the rule just sort of says this, like it throws it out there. Like if you're a data provider, you're permitted to, charge some set of fees that correspond to cost recovery. I highly, highly doubt that any kind of rule coming out of this CFPB is actually going to define what that looks like, right? And actually, even talking through this, the only historical precedent that immediately comes to mind is interchange under Durbin.
That's what I was thinking too.
Which of course has also been kind of like historically and at present a bit of a hot button issue in that I believe the Federal Reserve was supposed to recalculate that. Was it every year?
Yeah.
I don't have this in my notes in front of me, but I believe they were supposed to recalculate it every year, and instead they just never recalculated it. And are currently,
because it's a tricky calculation to make, right? Like it's the subject of a great deal. Like I was thinking about it in the context of when Chase came out with its pricing, right, and said like, hey, here's the pricing everyone needs to pay. And the pricing was like outrageously expensive. And so then Plaid and others spent the last, few months negotiating with Chase to get the pricing down to a lower level. and also to get Chase to commit to making technical improvements to its API in order to improve the performance and make it like better for everyone involved. And so like it's kind of a funny way to think about it, but like Chase actually agreed to spend more money on its API and to charge less in fees than it was charging before. And that just suggests to me that like I don't know that it would be a wise policy choice. And again, I'm saying that with tongue in cheek because I don't think the CFPB thinks along these lines at all right now. But I don't think it would be a wise policy choice to trust individual banks to just like, yeah, we promised this is what our costs are. Like Chase is going to spend $18 billion on technology this year. How much of that $18 billion could you assign to the costs in a broad sense of standing up and supporting these APIs and making sure that it's secure? I mean, you could assign a lot of the costs if you wanted to get creative in your accounting, or you could assign very minimal costs. And what you end up deciding to do, or what the CFPB allows you to do, is a function of market power and to what degree, if at all, the CFPB cares about or is able to like monitor this and try to regulate it. And I just don't, to your point, I don't have a lot of confidence in that.
Yeah, I mean, I suppose there's a continuum where the absolute lowest number is like, what is the incremental cost of a single API call?
Sure.
Which presumably is very, very close to zero. I guess not literally zero, but probably very, 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 very close to zero. With the other extreme being capturing the cost of the cost to stand up this infrastructure, the cost to maintain it, the cost of every legal and compliance person, every product manager, every engineer,
every customer support person, right?
Yeah. And so, you have potentially a very, very wide range that one could attempt to defend as like the cost of, providing this service. And, as you pointed out or implied, like the data providers, which are overwhelmingly, the larger banks, have every incentive to make that number look as big as humanly possible.
Right. Well, and I think like kind of going back to the CNBC story, I just think that like ultimately what's going to happen, the CFPB is going to put out whatever they're going to put out in their rule. Their ChatGPT written rule that's going to take 3 weeks to get done. And I mean, honestly, just as a side note, if I was trying to craft a rule as complex and long and comprehensive as an open banking rule, and I had to do it in 3 weeks, it would take me about 3 weeks of just prompting and reprompting ChatGPT to get something even like approximately close. So maybe that is what's happening. But like the reality is they're going to do whatever they're going to do. Market forces are what are ultimately going to determine what these fees actually are, right? Like Plaid hammered out a deal that it could live with Chase. Akoya presumably did whatever Chase told it to do. Yodlee found something it could live with. Morningstar found something it could live with. MX and Stripe and Trustly and Finicity are all still, I think, in negotiations to some degree. They're all going to negotiate with other banks that are probably going to have a little less leverage than Chase, but are going to do their best. Like this is going to get worked out in the market. And it was funny because a quote from a JP Morgan Chase spokesperson in the CNBC article said, "This is the free market working." Which was such a funny quote because, like, yes, that is exactly what this is. This is the free market working when the free market is completely unfettered and whoever has the most market power is able to set the terms. That is that quote is exactly on the nose. This is the free market working. Yes.
Yeah, I mean, the free market is not does not arrive at an instantaneous answer, right? So I know that,
correct.
When the bit about the original sort of JPMC fee story and then Plaid capitulating to JPMC's demands, which is how I will continue to frame that.
You have to,
at the time, Plaid said or implied that it was not going to pass along these costs to its customers, so to the data consumers, to the fintechs that are ingesting this data. Even if we take that at face value in the near term, which I think you and I have talked about this, like presumably the contracts between Plaid and its customers probably don't even allow for that. So like eventually there will be a contract renegotiation period. Like I have a very hard time believing that if data providers, banks begin charging a material amount of fees, that your aggregators are not going to find a way to pass along those fees. It's like, I don't see any other possible direction, particularly for all of the ones that are not Plaid, right? That are not sort of like the largest in the space.
Right.
And then how does that impact, what are the market forces on the companies that are ingesting and using that data? Like, this is honestly the piece that I'm almost the most interested in. Like, are there use cases, whether it is, cash flow underwriting or continuous monitoring of somebody's linked bank account for some sort of like overdraft avoidance type product, or account linking. So like, I just, open Venmo and I need to link it to my bank account. Like, there are potential use cases that become financially not viable once this pricing actually flows through to the companies that are using it. And that, I think, by the time that happens, it's like too late, right?
Yeah.
Like the ship has already sailed.
Totally.
And two, at that point, it's the facts on the ground, and it's going to be very hard to change. Something I'm curious, we saw what I'll call the Winklevoss factor weigh in earlier. Yeah. I'm using that as a stand-in for just sort of like crypto stablecoin industry more broadly. Yeah. Do you, Alex, think is there any opportunity or any risk for our frenemies over in crypto world to apply any pressure on the politicians they've donated so generously to?
Yeah, it's a great question. I mean, Stripe is the one to watch, right? Because Stripe has a data aggregation service. It mostly is a wrapper on top of other existing data aggregators, and then probably a few direct connections with some of the larger financial institutions. So Stripe does some data aggregation itself. And Stripe, obviously, like one of their big use cases for open banking is pay by bank, which is one of the use cases that's a little more price sensitive and margin sensitive, right? Like I actually don't worry that much about cash flow underwriting because there's so much margin in lending that all the lenders I've talked to who use cash flow data, they're like, like we could afford it. Like, in mortgage, they pay Equifax like trillions of dollars seemingly to get access to the Work Number employee verification. Like there's a lot of margin to be had in different lending products. Pay by bank is different though, right? Like the whole value proposition of pay by bank is we can make this incrementally cheaper than debit cards. And so therefore you should want to use it, and we can make it much cheaper than credit cards. I think Stripe will be the one to pay attention to because they could choose to pick this fight if they want to. And they have a lot of heft, I think, in policy circles. They have a lot of ability to get the crypto community and Tyler Winklevoss stirred up about it if they want to. My sense is that Plaid defecting or capitulating kind of broke the like tech, crypto, fintech aggregator, like strategic alliance on this issue from a policy perspective. I think when Plaid broke from them, it kind of fractured that alliance. And there's still like the Financial Technology Association and other trade associations, FData, like there are organizations that are still trying to kind of keep everyone else on the reservation, so to speak. But I don't think that they are going to have as much success. And I would imagine that Stripe kind of quietly just figures out a path forward here and doesn't make a big stink about it. That's my best read at this moment. But you never know when Tyler Winklevoss is going to tweet about something or David Sachs is going to pop his head into the White House Oval Office. And so I just don't know what's going to happen there. The other thing I was thinking about, Jason, I'd be curious for your take on this is, let's say the CFPB says, all right, data providers may charge a fee. But they sort of leave the details on like what that fee is up in the air and just say it needs to be, here are the guardrails, it needs to be reasonable, it needs to be based on your costs. Okay. That doesn't necessarily translate into every data provider will be able to charge fees, right? So like, again, going back to the free market thing, Plaid and Chase had the leverage to force Plaid to like come to the table and like negotiate with them. A few others probably do too, right? Like Bank of America, Wells Fargo, Citi, Capital One. Like there's probably a set. PNC despises open banking. They'll probably try to use whatever weight they have to get a deal. But once you get down, even not that far down the list of large banks, the amount of volume they have relative to the big guys really drops off from a data aggregation perspective. Just because they technically are allowed to charge fees, does that mean that like Plaid is just going to go, hey, you're a data provider, we'll charge you fees, tell us what you want? Like, I don't think that's going to happen. And so the other thing that I find interesting about it is, absent some more defined, like every data provider gets 3 cents for every poll or something, like absent some actual like number and math that the CFPB does where they are very prescriptive. If they don't do that, what ultimately is going to happen is Chase is going to get paid for its data. Capital One will probably get paid for its data. Wells Fargo will get paid for its data, but Frost Bank won't. First Interstate Bank won't. Huntington probably won't, right? Like there'll be a set of banks that are still relatively large and would like to probably get a slice of this that just won't have the leverage to get anything out of any of the data aggregators. That would be my guess. Do you have a perspective on that?
No, that's a great point, right? If I'm the team at Plaid or whichever other open banking aggregator that is dealing with that question, if I'm looking at, I just Googled largest banks by assets. If I'm looking at number 35, Comerica, what is it that I'm looking at? Like if I just say, no, we're not going to come to a deal with you, how many end users who were linking through Plaid are now going to be unable to? Like what percent of number of users, number of transactions, revenue? And I think you're right that if you get to a point where you're sufficiently, down that long tail, like the negotiating dynamics have changed, and it's like, hey, like maybe I'm just going to say no, like I'm not going to pay. And your users, Comerica or East West Bank or Zions or Santander or whomever, they're going to be annoyed when they go and want to try to link their bank account and it's not an option. And they're not going to call me. Right. They're going to call you. So good luck with that.
Yeah, no, exactly.
So, and sadly, this just reinforces the monopoly power, or I guess oligopoly, to be fair. It just reinforces the market power that Chase has to extort rents, its rent-seeking behavior, which further gives it an advantage versus all of these institutions that are outside the top 10.
That's exactly right. I mean, like there's a very realistic scenario here where Chase is able to charge whatever price it wants. And the CFPB, even though technically they say, hey, it has to be based on your costs, when Chase says these are our costs, the CFPB just says, okay, cool, that's great. And so like the CFPB can charge, or the Chase can charge whatever it wants. The CFPB doesn't get in its way. Smaller banks are not able to, which puts them in the position of either turning off data aggregation and blocking the data aggregators, which would have the effect of pissing off their customers and potentially driving them to Chase, or giving their data away for free and not recouping any cost the way that Chase is able to say nothing of the fact that, again, just to point this out, Chase is one of the owners of Akoya, which it's going to be collecting fees from. And you have to imagine a scenario where Akoya is profitable in the future and they are distributing money back to their owner banks. And Akoya is able to charge money or is able to pay money to access the data, but then the money that it gets back flows back to the big banks, including Chase. Like there's just some very strange and, to your point, kind of anti-competitive dynamics just sort of everywhere in this ecosystem. And I don't know, this whole process is really making me feel a great deal more sympathy for the Biden era CFPB, which was like trying its best to create a rule that would last and that would maybe withstand legal challenges and that would just sort of balance everyone's interests. And you can quibble with some of the end results of their rulemaking process, but they were really trying to wrestle this very complex market to the ground and create a structure that everyone could live with. And
we don't do that anymore. We don't do that anymore.
Alex. No, it feels like we're just headed into
if we ever did, to be fair. But.
Right. It feels like instead we're headed towards this world of hey, here's the free market. And the free market in the United States means the biggest get to push everyone else around and lawyers get paid a ton of money to litigate this in court forever. To me, when we say free market and open banking in the US, that's exactly what it's going to look like for the foreseeable future. So super fun, just maybe not quite as depressing as our visits to Bass Island, but not depressing either. Jason, yes. I am going to ask you to give us a recap on a story you actually wrote about in your newsletter recently.
Yeah, speaking of monopoly power, that's
Great
my segue. Excuse me. A not banking as a service related story. Earlier this month, Apple, in its latest iOS update, rolled out what the company is calling digital IDs. Now, Apple has supported mobile driver's licenses, or MDLs, actually for several years now. It has been something of a slog, though, because Apple has to integrate with each individual state's issuer of driver's licenses or state IDs, which is most commonly the Secretary of State's office. Not sure what the Secretary of State in Montana looks like, but in Illinois, I would not describe it as a tech-forward organization. As far as what this actual digital ID is, it's a capability that allows iPhone users to create a credential that lives in Apple Wallet from their existing US passport. So I actually did this a couple days ago just to test it out. And the flow basically looks like a KYC process. You take a photo of the picture page of your passport. You actually use the NFC chip in the phone to scan the chip that's embedded in your passport.
Interesting.
I haven't really seen that in the US market, but I will say living here in the Netherlands, my residence permit, and I think maybe also my driver's license have this kind of like RFID or NFC chip embedded in it that you can literally scan with your phone as part of a identity verification flow. Take a selfie and then complete a series of head and facial movements in a process like known in industry as a liveness check. So basically making sure that the selfie matches the scan document and that you are really the one holding the phone, at least hopefully. But in reality, there's still very few places that you can use either the mobile driver's license or this new digital ID, with the main use case being at about 250 TSA checkpoints where this technology is being piloted. So this rollout really does remind me of the long game Apple paid with like Apple Wallet / Apple Pay. Alex, I'm curious, when and why did you first begin using Apple Pay, if you can remember? Or do you? Do you have a confession to make that you don't use it?
I do have a confession to make, honestly. So no, what's funny about it is, and it's one of the things I actually really like about living in Montana, is I get to be on the tail end of fintech and tech adoption, not like the front, like cutting edge of it, right? And so if you go to New York, or you go to San Francisco, or you go to Miami, or perhaps Utrecht in the Netherlands. Did I say that right, by the way?
Pretty close.
Close? Okay, all right. I'm still working on my pronunciations. Lots of places are sort of contactless by default, right? And so there's a lot of like, I don't ever take my wallet. I just use my phone. I pay with Apple Pay. We don't do that in Montana very much. So we have contactless terminals. You see some people pay with Apple Pay, but I actually don't use it that much because I haven't been able to get to the point of having ubiquitous enough acceptance that I can take my phone and not take my wallet. Does that make sense? And so I haven't gotten to the point where if you live in New York, why would you have your wallet? You just have your phone, everything's secured by biometrics. You pay for your train ticket or your subway pass with your phone. You buy groceries with your phone. Everything is just on your phone. We don't quite have that level of like seamless, ubiquitous tech adoption in Montana. So I, as a fintech nerd, am signed up for Apple Pay. I have, of course, experimented with it and tried to break it at the point of sale, which pisses off my wife. But I don't use it on a regular basis. I have also experimented with the ID stuff, although, again, I will say, maybe this speaks to our state government. Montana is not, I don't believe, on board with digital IDs almost in any form. We're kind of privacy obsessed out here. And so we do not have any of that. And I guess, Jason, my question back to you is, like, you've signed up with it. Have you used it? Like, how's the experience? Do you have any sense of like how it actually works in the real world? When it comes to your payments provider, you can't afford to compromise. Marqeta's modern payment solutions flex with your business without the trade-offs. Stable and agile, secure and innovative, scalable and configurable. If they say you can't have it all, don't believe them. Your business demands more. Choose a payments provider that delivers more. Choose Marqeta. Visit marqeta.com/FTT to learn more.
So only
You travel
I have
a
not.
lot.
I have not actually used it because I literally just signed up. Illinois does. I still have an Illinois driver's license, so I did both the MDL with my Illinois license and the digital ID, which I should carve out and say explicitly does not work as a passport. It's like it's derived from your passport, but you can't like show up somewhere and show that to the immigration person. Like they're not gonna let you in.
That's funny.
I mean, my sense from sort of like observing people at the airport, I have seen people do this. It is that, like, in theory, the way this works could or should be privacy enhancing, to your point about the state of Montana. Apple, as compared to some of the other big tech companies, namely Google, Meta, like Apple is not as much a like ad marketing monetization driven company versus Google and Meta, which overwhelmingly are.
So they make their money on hardware, right? Yeah.
I mean, so the positioning is, at least in theory, like this should be security enhancing because Apple only surfaces the minimum information necessary for the use case. So I think TSA might be a little bit different because I think it surfaces basically everything that would appear on the license. But Apple's like long-term goal is clearly, you're at a bar or at a liquor store. The only thing that merchant needs to know is Alex is over the age of 21. They don't even need to know what your birth date is. They just need to know like binary, like yes or no. Is he over this age? Now, is that think about the long tail of adoption on Apple Pay. And in my mind, this identity use case is probably significantly more complicated. So to your point, right, in this sort of like TSA, which in theory is like the easiest sort of most controlled scenario. Yeah. Like you need to have the actual physical device to read what I'm presenting on my phone. You need to have all of those TSA agents like trained to understand what is this? It's acceptable. I can use this as a valid form of ID, which I would guess is probably pretty uneven. I mean, there are, and Apple's also competing with some of the airlines. I noticed. I forget if it was Delta or United or somebody else, has their own like Delta ID, which is like a comparable thing that is used, I guess, literally only for this use case of like being at TSA. So I mean, this like, I find that this is interesting. I do think it is going to be much more of an uphill climb than Apple Pay, because in my mind, it's like, what is the actual incentive, even in this like TSA use case, what is the real incentive for consumers to adopt this? Like, if I'm going to the airport, I'm probably not going to rely on my phone the way that you were describing. I do rely on my phone day to day here in Utrecht. Like I don't, I don't take my wallet with me because I know when I need to pay for something, everywhere except Apple Pay, and it's not going to be a problem. I will say one time a clerk at the store wanted to card me to buy a bottle of wine. The age, by the way, is 18. The age, by the way, is 18 here, and I just had to laugh and be like, "Really? You think I'm under 18? That's very cute." That's nice. I digress. I mean, do you see strong enough incentives in any use case, whether it is that, I'm buying something, an age-gated product in person? Increasingly, there are states that are passing age-gating requirements primarily around adult content and to a lesser extent around social media. So you can imagine a use case. And I think some of the adult content sites have really been pushing, saying this is the age verification capability is something that should live at like the device or the OS level, right? Rather than living at like every single website level. Like they don't want the responsibility, the complexity, the cost, the legal, compliance risk, whatever, having to do that. Yeah. Like, do you think there ever could be enough incentives to encourage users to, onboard, so put in their, passport or their driver's license and then actually use this in person? And what would those
Yeah.
incentives be? Like, am I going to get through TSA faster? Because it doesn't look like it.
Well, I mean, it's a great question, right? I think that going back to Apple Pay, I guess one thing that surprised me about Apple Pay was that and you remember this, like when Apple Pay launched, everyone was like, mobile wallets are here. And then like it didn't get a lot of adoption right away. And then everyone was like, mobile wallets don't work. And then like we came back to Apple Pay like, a couple years later, and it's like, look how much growth they've had. Mobile wallets are here. And then like the growth didn't really go that much further. And they're like, mobile wallets are dead. Like what it kind of taught me was, especially with something like this that requires like behavior change on a large scale, I think what happens is there's a process of building out the infrastructure and getting enough scale that it works anywhere, right? And so like with Apple Pay, Apple had to get the card networks on board. The card networks had to sort of drag the issuers to be on board. I seem to recall there was basically sort of a leverage play at the time, which was, hey, Visa, MasterCard, you really should get on board with this, because if you don't, we're going to create our own closed loop payment ecosystem.
That's right.
And we'll cut you out of all of this. And so Visa, MasterCard are like, we'll do it, and we'll pay you more on top of interchange, which the issuers still grumble about to this day. But like Apple had to use some leverage to get a large part of the market on board so that it was like kind of somewhat ubiquitous from the start. But even once they had that, call it coverage built out, and it worked in a lot of places, merchants kind of slowly upgraded their terminals to support contactless and NFC-based payments. Like even with all of that happening, the user behavior journey was like every year you pick up like 1.5%, 2%. Like it was just this very slow climb. It wasn't like a hockey stick. It was just boop, 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 incremental. And I kind of think the same thing is going to apply with identity. The challenge, though, to your point, is Apple doesn't have the same leverage with all of the states or with all of the issuers of identity credentials that it was able to manufacture with Visa and MasterCard, right? Like Visa and MasterCard were a sort of choke point for the entire industry, little reference there for you, that allowed Apple to like force a lot of like compatibility right at the very beginning, and then they could slowly chip away at like user adoption. I think the good news is they have users trained on use your phone to conduct transactions. That's great. But I think the process of getting the individual states, getting the US government on board, getting organizations like TSA on board, getting whoever regulates like, online pharmaceutical sales for age verification, right? Like there's just so many, like identity is so diffused across so many different groups that have responsibility for different parts. It's not like payments, right? Payments is concentrated. Payments is centralized. Identity is not. And so I think that's one problem. I think the other problem is, and this relates to like building out any kind of standard. The problem is like Apple's like, hey, wouldn't it be better if this just worked tomorrow and we could just make our lives easier? And everyone is like, yeah, it would be easier. But there's a whole bunch of other corporations that don't just want to cede this job to be done to Apple, right? So like Google has a say here. Clear has a say here. Mm-hmm. The big banks kicked around the idea of creating a digital identity consortium through EWS at one point. Like there's all of these other organizations that don't just want to cede this market to Apple. And so I think competition is also going to slow down the adoption of digital identity because people are going to be pitching different solutions to this. They might be using different like technical standards. So digital identity, even though it's such an obvious need, it has a lot of like market challenges that make it hard to build enough momentum around to really see large scale adoption.
I would say my last point, and then we can very briefly do our last story, is the sort of like, at least I would argue or perceive like higher stakes situation of an identity credential and what happens if that's not accepted versus my payment card. So like I will go around my day-to-day life here in Utrecht just using my phone to pay for things. But if I were like traveling to whatever, Paris or London or the US, like I wouldn't not bring any cards with me. Like in the event that like I need it for some reason, whether that is getting cash at an ATM or something. In the identity credential case, like can you imagine if you go to TSA you're all ready to take your flight home to Montana, and they're like, "Oh, sorry, Alex, the mobile driver license reader is down, so like you can't come into the airport. Goodbye," right? Or
totally,
or getting pulled over, and it's like, "Oh well, I don't know what this is. Like, I'm going to arrest you now." So that's
exactly right. That's exactly right. Right.
The risk of it not being accepted. Yes. To me, anyway, feels much higher than like if I'm at the grocery store and they're like, "Sorry, Mr. Mikula, like we can't take your mobile payment." Like I'll just leave and get those groceries later.
That's exactly right. No, I mean like the cost. Well, I mean not to put it in too dark a place, but like the cost of not being able to prove who you are just keeps going up, right? Like the risk of that. I mean that we have some stuff happening in the U.S. right now where it's like I really want to be able to prove my identity, and so I mean I just think that like being like, "Oh yeah, no, it's cool, it's on my phone. Just give me 1 sec to like pull up the app." Like in a payments context, that makes me nervous enough. In an identity context, in almost any place where I need to prove my identity, the stakes are much higher. And so I think that's a really, really good point. Jason, do you want to take this next story? Or would you like me to?
We can do it very briefly. So Green Dot, kind of an OG, some might describe as an OG fintech, has or is going private. So private equity firm Smith Ventures is acquiring the non-bank assets and operations of Green Dot as a, quote, independent fintech and embedded finance company. And Commerce One, which Smith Ventures is also an investor in, according to its website, will acquire Green Dot Bank to form a publicly traded bank holding company, which will include Commerce One's existing bank subsidiary. And that combined entity will serve as the exclusive issuing partner for this, quote, independent fintech and embedded finance company. I will not read all of the terms of the deal. If you're very curious, I can link to them in the show notes or Google it. I do think I will point out that according to the press release, the implied value of Green Dot, the whole thing, so the bank and then this like non-bank fintech part, is estimated to be between 825 million and 1.1 billion. Alex, do you know how much Green Dot was worth when it IPO'd in July of 2010?
Oh, 2010. I do not.
Yeah, I definitely spent some time Googling that. It had a market cap after it began trading of 1.76 billion. So that means not even adjusting for the very significant amount of inflation in the past 15 years, Green Dot is worth substantially less now than it was at the time it IPO'd in 2010. I know we have very little time. My main question is like, what, if anything, should we take away from this when we're looking at other players in this sort of like bank fintech partnership space? So both banks as well as, technology platforms. So I'm thinking, players like, well, Blue Ridge left the space, players like Column, Cross River, Thread, and then on the tech platform side, your Treasury Prime, Units, Infinance, Syncteras, and so on. Like, are there any lessons we should parse from this, or is it like non-generalizable?
Yeah, it's a great question, right? Because Green Dot was one of those companies that has kind of evolved as the market has evolved, right? I mean, they IPO'd in 2010. That's ancient in fintech terms, and that's and
it had been around for many years already at that point.
Right, and like they bought a bank, right? Like they weren't a bank, and then they bought a bank, and so like they kind of did all of this like in an earlier generation. I think that the lesson I would take away from it is that it's really hard to combine banking and technology. And obviously, like, that's a overly simplistic statement that I don't think anyone would really disagree with. But like in a banking as a service context, we know that a lot of banks, community banks that are interested in getting into banking as a service really struggle on the tech side, which is why all of the banking as a service middleware platforms have popped up over time. It's why the core providers have acquired some of those middleware providers. Like, it's really difficult for community banks to bring their technology up to the level of being able to support the types of like fintech programs or partners that they want to work with. However, then you see companies that are maybe like a tech kind of fintech infrastructure company that buys a bank, like Green Dot did at one point. Or more recently, you see tech entrepreneurs like William Hockey buying Column, or Jackie Reeses buying Lead. Those, approaches have the benefit of, okay, now we have a bank charter and we're going to bring our expertise at building tech companies to this place, and we're going to build out all the technology. From what I understand, Lead and Column have very good technology that really is kind of considered state of the art relative to the average in banking as a service, which is why they tend to win a lot of the really big, sophisticated programs. But I think the thing that I'm taking away from this Green Dot lesson is, Green Dot was publicly traded. And I think that stock market analysts have a really hard time evaluating, should we value this as a bank? Is it a bank? Is it a technology company? If it's a tech company, what kind of multiple does it deserve on top of its revenue? Typically, banks are evaluated very much based on their book value. I think there's a really difficult challenge in kind of blending those two things together, which is why I kind of wonder, going back to the structure that you talked through, like the private equity firm is buying the non-bank assets, but it also is an investor in the bank that is buying Green Dot Bank. Is that right? Is that what you said?
According to the logos on the private equity firm's website, it is an investor in, I guess, what would appear to be the bank holding company, or what will become the bank holding company that is sitting on top of Green Dot Bank and this Commerce One. Yeah, Commerce One.
Got it. And then this combined bank is going to be the exclusive partner of Green Dot, the non-bank, which is also owned by this private equity firm. So, to me, one way of reading this is, nothing really changed structurally, right? It's still the fintech business and technology business built on top of roughly the same bank charter that has this exclusive, combined value proposition that they're going to go out to the market and try to serve. What this suggests to me more is that private equity is sort of skimming the technology off of the bank from a market perspective, so that these two things can be thought of as separate entities and can be valued appropriately. And so to me, I almost wonder if it's more a maneuver to get it off of the public markets, which didn't really understand what this combined Frankenstein type entity was, and take it into an environment where they can kind of simplify the different jobs to be done, even though the structure of technology built on top of a bank charter is still roughly the same. And I wonder what that tells us about other banks that are trying to kind of thread this needle, whether it's Cross River or Column or Lead, or you mentioned Increase, which their founder just bought a bank. In all of those cases, maybe this is something that can only exist in sort of a privately owned capacity, but just the public markets don't have a stomach for it.
That is, I actually do not know off the top of my head how many banks that play in the fintech partnership space or in the technology adjacent space. I do not know how many of them are publicly traded, but I would guess probably not many.
Yeah.
Which I think that might be the most conclusive takeaway of public markets have a hard time valuing these kinds of combined businesses. I mean, I'd be curious. I haven't followed SoFi extremely closely, and it's also not a perfect analogy for a lot of reasons, given that its main business is lending, not
but they own
sponsorship.
Galileo,
they own a lot of stuff because Galileo,
yeah.
Technisys, yeah. Mm-hmm. I'd be curious to speak to a real hardcore equities analyst and how they think about valuing those different component parts of SoFi's business.
Well, and SoFi is a good example, actually, because I think the only way that SoFi kind of gets away with this a little bit, even though it is publicly traded, is SoFi went public via a SPAC, as we know, and they still have a very passionate retail investor base who I've always noticed the CEO, when they do stuff, he tends to speak more to the retail investors rather than the institutional investors. And you run into these SoFi bros on Twitter, they'll still be no, SoFi's building the AWS of fintech. You don't understand. And I'm I kind of think I do understand. And I don't think you maybe understand, but I think it requires, I think that pitch, that AWS of fintech, which is always the banking as a service, technology plus a bank charter. That's always like the analogy that gets thrown out there. I think that requires irrationality to believe in. And so if you are a publicly traded company, you need like a really strong retail base of investors who will just sort of blindly believe what you tell them, or you need to be private and you need to have a different like incentive structure wrapped around it. I think it's pretty hard to have those hardcore equity analysts kind of constantly hammering you every quarter and you being, well, I know our loan to value ratio for this portfolio isn't quite good, but look at what we're doing on the tech side. Like, I just don't think you can like merge those two parts of, it's almost like two halves of your brain in the public markets. Like, I don't think those fit together very well. But I suppose we'll see how this space evolves. Maybe this is the beginning of a renaissance for Green Dot. Who knows?
Not going to hold my breath, but maybe. Should we wrap it up with what we cannot let go of?
We should. I'm going to ask you to go first. I know you had a couple different options. I have one that I needed time to wind up on a little bit, so you go first.
All right. I picked one that will thematically align with yours, which is some revelations, or I guess I should say more specifically allegations about Meta, parent company to Facebook, Instagram, WhatsApp, in a lawsuit. And I'm just going to quickly read some of these that, quote, Meta intentionally designed its youth safety features to be ineffective and rarely used, blocked testing of features that might be harmful to growth, that Meta required users to be caught 17 times attempting to traffic people for sex before it would remove them from the platform, which the internal document described as, quote, a very, very, very high strike threshold. That Meta recognized that optimizing its products to increase teen engagement resulted in serving them harmful content, but did so anyway. That Meta stalled internal efforts to prevent child predators from contacting minors for years due to growth concerns, and pressured safety staff to circulate arguments justifying its decision not to act. This is just like a small sampling of the allegations in this lawsuit. I mean, there were also a number of, I think, increasingly apt comparisons to tobacco companies. And also, I guess, to oil companies, sort of like having this internal research that's like, oh, yeah, our stuff's real bad. And then instead of deciding to like take any steps whatsoever to mitigate those risks and problems, instead choosing to bury that research in order to protect the company's bottom line. I don't necessarily think there is a high degree of likelihood that we see any sort of like legislative or regulatory reform when it comes to like the internet broadly or social media more narrowly. Like, it just doesn't feel like something that in the current administration, or frankly any administration, there is the firepower to get done. I do think there is just an increasing amount of evidence, even setting aside like AI and all of the potential harms. And I'm sure you and everyone listening has seen sort of the anecdotal stories of somebody committing a crime or harming themselves after interacting with a chatbot. Like, this is, I'm going to get on my soapbox of like still believing that government can be a force for good. Like, these are the reasons that we have government, that we have legislators to act on behalf of society, to, when necessary, like protect us from the things that we as individual consumers, as individual people, are utterly, frankly, incapable of protecting ourselves from. And I think that like this, latest bad news story for Meta really exemplifies that like we cannot and should not trust these for-profit companies to act in any interest but their own, even when that means incurring very real, very significant harm, like negative externalities in economist speak, on society. And I will leave that there as a segue into yours. Oh gosh, which also is crazy, but wind it up.
No, thank you. I appreciate that. You'd already got me wound up because I think you're exactly right about that. I mean, I saw all the Meta stuff. I think actually in the discovery for the lawsuit, they found employees comparing themselves and what their company was doing to the tobacco companies, like in the 40s and 50s.
Like in the internal documents, yes.
In the internal documents, like the employees were talking about, like, isn't this kind of like when the tobacco companies really had great research on how bad their products were for consumers and they decided to suppress that information? And they're like, yep, but we're going to do it. I mean, like, it's bad, and, you know, like really like bad negative externalities. I mean, I've said this for a while because I think about this in the context of my kids who are too young for social media. And if I have my way, will always be too young for social media. Like, I think in the future, you know, social media is going to come with a Surgeon General's type stamp on it, like the way that a box of cigarettes do. I just think like it's that harmful to particularly young brains, which does bring me right to my story, highly related. This was an interview that was done by Kevin Roose and Casey Newton, who do great reporting on the tech industry, with the CEO of Roblox. Do you know Roblox? Do you play Roblox?
I do not. I think at some point I downloaded it because I felt like I should understand what the kids are doing, and I just never opened it and never used it. So no, I am aware of what it is. I do not play Roblox.
I don't know that I could really accurately describe it that well, but I will say it's a video game that creates like an immersive virtual world where you can build your own sort of world. That's the idea. And it is supposedly the largest kids gaming platform in the world, right? It has something like an average of 85 million daily active users. And according to the company, their monthly player base includes half of all American children under the age of 16. That's right. So kind of going off of your earlier point, like obvious safety issues when you have a lot of kids on a single platform. And they have been involved in more than 20 different lawsuits and multiple state investigations over issues related to child safety and trafficking of children and all kinds of like very bad grooming, like bad things happening on this platform, which if you have that many children in one place digitally, like that's just going to naturally happen. So they're doing this interview with the CEO. They're asking him about safety issues. He's really kind of blowing off all the concerns they have about safety issues and saying like, well, do you have any idea how hard a problem this is to solve? And they're like, yeah, but like it's the problem you signed up to solve by having this platform. So, you know, the conversation is sort of going off the rails. And then Kevin Roose asked a question just as sort of a joke, which was, quote, would you ever put a prediction market inside Roblox, like let kids bet with their Robux, which is the internal game currency, saying something like, I bet this is going to happen in the game. And the CEO said, with complete sincerity, from what I can tell, we would. I think we would have to do that. Once again, I'll share some of the complexity. Every single country in the world has different legislation around loot boxes and kid gambling. And so we would have to be, it sounds very fun and obvious, like I love that. And then they kind of interject and say, well, we were just kidding. We think it's actually a really bad idea. And he goes on to say, well, I actually think it's a brilliant idea if it can be done in an educational way that's legal. So imagine no free Robux, no free prizes, just a game where it's not like trying to get kids money or anything like that. I would be a big fan of it. And it's one of those things, Jason, where like in these unguarded moments that you sometimes have on podcasts, you get like a window into just how sort of different, I guess, tech CEOs think about building products. Like clearly like, oh, I'm seeing the success that prediction markets are having in just driving raw engagement. I don't really care what the effect is on users or if it's actually a good thing for society or not. So like his brain immediately jumped to, I love the idea. We just need to figure out a way to get around all of the legislative things that would block us from introducing gambling to kids. Like, that's insane. And the podcast host, by the way, said it as a joke. And Kevin Roose afterwards was like, tip to podcast hosts, never forget to ask your silly joke questions because you never know when you'll get a sincere, enthusiastic yes, which is what they got in this conversation.
I have not yet listened to that podcast. It's on the queue for the dog walk this week, but I read online that it was described as like a car crash. So I'm looking forward to it.
Yeah. It's quite something. I think Roblox comms team probably has some work to do in terms of prepping CEOs for podcasts, and maybe he shouldn't go on more podcasts until then. But I'm grateful to have gotten this window into just how insane the tech world is right now. And suffice it to say, not a fan of that idea.
I mean, I think only if they can do it with 100-to-1 leverage, then I'm all for it.
Well, I mean, like, start them young is kind of the motto, right? I mean, like, I can't send my kids out into the world as young adults not knowing how to like seamlessly navigate prediction markets and think about applying truth to the world. Like, I'd be doing them a huge disservice. So I should probably get them started now in Roblox, just practicing prediction markets so they can be prepared for the casino economy that they'll be entering.
Very uplifting note to end on. Thank you, Alec.
You're welcome.
I suppose by the time this comes out, people will already have had Thanksgiving. So hopefully everyone had a lovely Thanksgiving.
I hope so too. Yeah. I mean, I know, Jason, that it's already really dark and depressing outside for you. Dark. So I just wanted to like help set the mood for the rest of your evening. You're welcome. You, sir, have a great Thanksgiving. I hope you get a good break from all the craziness, and we'll do this again soon.
All right. Till next time.
All right. Thanks, buddy. Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.